Welcome to the Daily Rundown Show. This is Mike at WIC. Let's talk the market today. All right, how could the S&P 500 close at a record high when we got such a terrifying inflation number this morning? The S&P climbed 0.5%, while the Nasdaq climbed 0.8%, but the Dow is flat. Simple. When everyone expects an outrageous government statistics, it's actually not so outrageous when you get it. This morning, the Labor Department reported a red-hot inflation number. Consumer Price Index is up 5% year over year, the biggest increase since 2008. Scary, right? No, the tech-laden Nasdaq, which is full of growth stocks that actually get hurt when inflation is high, that claimed nearly 0.8%. The inflation winners in the Dow underperformed today, and in fact, most of them were down. So what happened? It's like when you throw a surprise party for someone and they knew. For months, even an amateur group like us knew that inflation would be hot. This is because of the base effect from last year as we compare this year's numbers to last year's in the midst of everything shutting down. Of course, we get hot numbers if we compare it that way. So that's what's called the base effect. The fear of clueless big money who have been waiting on the sidelines for this number, and when the number came out today, there's nothing freaked out about that. The buyers came in, and we're in a sweet spot for the S&P 500 right now. It may not be a surprise, but 5% inflation seems pretty serious. Would it force the Federal Reserve to raise interest rates and tap the brakes on the economy? This is the case where you have to take a look at the prints of that report to find out. Remember, Federal Reserve Chief Jerome Powell is his full name, keeps insisting that this inflation is transitory. When you break down the inflation data, it sure looks like Jerome Powell is right. Price of used cars up 7.3% in May and continuing to trend from April. Used vehicles alone accounted for a third of consumer price inflation. Transitory? You bet it is. Right now, we have a chip shortage because nobody estimated the huge demand in car production. Car manufacturers have not been able to expand production, reducing the number of available new cars. Thus, people have to buy used cars. Plus, there was a fire in a chip manufacturing factory in Japan, causing a huge chip shortage, although now that's coming back. Sure, given enough time, the production issues will come balance with the demand, and eventually we will come to equilibrium. It's transitory. Remember, there's nothing the Federal Reserve can do about the chip shortage. We need more production. We don't need higher rates. The other part of the consumer price inflation comes from airline fares. Of course, airline tickets are up huge year over year because who was flying in May of 2020? Nobody. We were all locked down. Now, people with stimulus money, high-paying jobs, and racked up vacation days are flying around the country to visit their families and even bring their families to travel to other places. Plus, airlines have always underestimated the boom that we would get from the power of these coronavirus vaccines. We would not, if you take us back to this time last year, we would not expect that this time right now, things are back to normal. No, the fast reopening caught everybody by surprise, and certainly airlines are not ready yet. They have to expand the capacity, and they will. Once that happens, airfares will come down. And in fact, what we think will happen is that this low interest rate environment that the Federal Reserve is keeping will encourage airlines to buy more planes, bumping up capacity, and that will, of course, drive down prices. Lastly, we talk about oil and energy prices. Those are up huge. It can be a bit tricky, but it eventually becomes a supply issue rather than a demand issue. During the Trump administration, what they did was they encouraged drilling. They encouraged building more pipelines. So when you have more supply, that drove the price of oil down. During the Biden administration, though, they are extremely anti-drilling and extremely against building new pipelines. They are not allowing any companies to build more pipelines. Oil companies also, on the backdrop of this new administration who is pro a clean environment, they are reducing production as well. Oil companies are. So when you have lowering of supply based on government restrictions, but also companies are doing it themselves, of course oil prices will go up. Again, supply and demand. So this has nothing to do with interest rates. If you have a government that is anti-oil drilling, anti-oil production, oil prices will go up. So the red hot CPI index that we got this morning did not catch anybody by surprise. If anything, it was the opposite. The reflation trades took a dive. Stocks that we've been talking that are anti-inflation, for example, banks or commodities or industrials, they took a dive today. Citigroup, a bank, we actually added some on the way down, was down 1.6%. Caterpillar down more than 3%. And stocks that would not benefit from high inflation or would get hurt by high inflation, growth stocks like Microsoft, Apple, Alphabet, Salesforce, they all rallied more than 1% today. So, all right, I'm not saying we've got inflation taken care of. However, we're fairly confident that none of these issues can be resolved by raising interest rates. Businesses simply weren't ready to handle the boom in the economy. So this is a high quality problem. They don't need a rate hike to work things out. Time will work things out. I think Jerome Powell is dead right, and he's doing a real good job. Bottom line, for now, it's okay to think that the hot inflation we're seeing is transitory. If anything, the non-transitory inflation we're seeing is the Wall Street bet stocks like AMC or GME, that were driven by a crowd on Reddit who've gone into their head somehow that they need to inflate these stock prices. Although, if you come to think about it, I think that's temporary. Given what happened to these meme stocks back in January, remember, GME came down from the highs of 400 down to as low as 40. And also today, it came down 30%. All right, that is my take on the market today. We are not discussing actions that we took in our portfolio. You can read more about those actions in the action tab of our website. We will be discussing those tomorrow when we have some time to digest what happened to the market today. So that's it from me tonight, and I will see you tomorrow.